Silver just flashed a structural signal that doesn't happen very often. While price pulled back, open interest quietly increased. At the same time, registered inventory levels inside COMEX remain under pressure. And when these pieces line up together, history shows something important usually follows. Most investors are focused on price alone, but price is only the surface. The real information is underneath: positioning and liquidity. Let's break this down clearly. When silver prices decline while open interest rises, it tells us new contracts are being added during weakness. That means fresh positioning is entering the market, not old positions closing. This dynamic is very different from panic selling. Now combine that with what's happening inside COMEX. Registered inventory, the metal that is actually available for delivery, has not been expanding meaningfully. That creates a structural tension between paper positioning and physical availability. This does not mean silver is running out, but it does mean leverage in the futures market increases sensitivity to dollar strength and Federal Reserve expectations. And that's where macro enters the picture. The Federal Reserve remains cautious about rate cuts. Bond yields have stabilized and the dollar index has been hovering near key resistance levels. Historically, when DXY approaches levels around 102 and begins to weaken, silver tends to respond quickly. Why? Because silver trades as both an industrial metal and a monetary hedge. When rate expectations soften and the dollar loses momentum, silver often accelerates faster than gold due to its higher volatility profile. But here's the key point: the setup forms before the move. Open interest rising during price weakness suggests positioning is building. If the dollar breaks lower or rate cut probabilities increase, that positioning can unwind aggressively in the opposite direction. The last several times this structure appeared, silver experienced sharp directional moves within weeks, not months. This does not guarantee an immediate breakout. Markets rarely move on schedule, but it does tell us volatility compression may not last. Right now, silver is sitting at a crossroads between macro pressure and structural buildup inside the futures market. If DXY pushes higher and yields rise again, silver could see additional downside testing. But if the dollar stalls and rate expectations shift, the fuel is already sitting inside positioning data. That's why watching open interest and registered inventory together matters more than daily headlines. Most retail traders react to price. Professionals watch structure. And structure right now is tightening. The next move may not be slow, it may be sharp. And that's exactly why this setup deserves attention. If you follow silver market seriously, keep watching the dollar index level and futures positioning changes over the coming sessions. Because when structure and macro align, silver doesn't drift, it moves. And when it moves, it tends to surprise the majority. This is Silver Shockwave.